We're going to have a look at what a repayment mortgage is. There are two types, broadly speaking, there are types of different mortgages. There are a lot of subtypes of mortgages. In fact, well, you've probably seen them all listed in papers and magazines and things. There are hundreds and hundreds and hundreds. Quite a few less now than there were 5 years ago before the banking crisis, but still quite a few. But they fall into two categories. You have, on the one hand, you have a repayment mortgage. And on the other, you have an interest-only mortgage. We're going to have a look at the repayment mortgage and talk about what... So, how does a mortgage work? Well, you want to buy a house. And to do that, you need to borrow some money. So let's say this house costs £200,000. You have 20k, so you have a deposit of £20,000. So you need a mortgage of £180,000. And you go to a bank to borrow £180,000 to buy a house, and they will ask you whether you want a repayment or a interest-only mortgage. Now, a repayment mortgage is where, as it says, you pay not only the interest on the mortgage, because the bank won't lend you the 180k without charging you interest. Now let's say that's 6%. Won't fit on there. Let me just get rid of that. Make it look better. So let's say it's 6%. There we are. So some of that money that you're paying back will be going to interest with your monthly payments, and the rest of the money will be going to pay back the original sum. So each month you will have a payment, and a proportion of that payment will go to pay off the interest, and a proportion of that payment will go to pay off the original sum. Now, a typical length of time or term for a mortgage is 25 years. So after 25 years of paying a monthly payment, you will have, each month you're paying off a little bit of this interest, and you're paying off, to begin with, a tiny, tiny amount of the original sum. The mortgages are worked out so that on a repayment mortgage, your first few years of paying them back tends to go just to pay the interest. You only really start to pay the lump sum off as you get further into this term. To the end of the 25 years, when the 25 years are up, you will owe nothing. You will owe no pounds on the mortgage, and the house will be yours. So you will have no further payments on it. And that is a repayment mortgage. An interest-only mortgage is different. And you will have money left to pay on the house. But with a repayment mortgage, you will have nothing left to pay once you have paid off the 25-year term. Just a quick talk about mortgages while we're on the subject. Mortgages are interesting in that they are a leveraged product. Now, what does that mean? Well, you want to buy a house. This is the house you want to buy. It's £200,000. You have £20,000, so you need a 180 from a bank. So think about it. Let's say this represents the money that it costs to buy the house. The 180,000 comes from the bank. The 20,000 comes from you. But you are using effectively £20,000 to buy an asset that's worth, as we know, £200,000. If that asset goes up by by 10%, that relates to a profit of £20,000. But for you, that's not a profit of 10%, because you only put in £20,000. That is a profit of 100%. So you have used £20,000 to buy an asset that's worth £200,000. That asset has gone up by 10%, and all the profit is yours. And that is the example of a leverage product. Leverage products can be very risky, and it's odd that the housing market is an example of a leverage product, because ordinarily most people aren't allowed to participate in leverage markets. You have to either be extremely rich, or you have to be a financial institution or a bank or something like that. Because the downside of leverage is that you get to keep all the profits. That's the upside. But the downside is that you also have to face the losses. So if the house then, for example, were to go down by 10%, 10% isn't a huge fall. And if you had £200,000 in a house and it went down by 10%, you might not be very happy about that, but you've still got 180k. But in the case where you've only put in 20,000 and the house goes down by 10%, you have lost 100% of your money. If the market falls any further, you are into negative equity. And the money that you're losing after that is the bank's, but the bank will want it back. And that's why negative equity is such a problem. And we will talk about that when we do the next video, which will be about negative equity. Bear in mind that with a mortgage, you are buying a leveraged product. And that can be risky. I'm not saying it shouldn't be done, but you just need to be aware of it. But anyway, that's just an aside. This video was about a repayment mortgage, which is where you just pay all the money back over the term of the mortgage at whatever interest rate the bank decides. It'll be something like 6. You might get a discounted interest rate, but that is a repayment mortgage. I hope that helps, and I will see you in the next video.